widely known, and that's not a particularly resilient system. And I was subsequently asked by the former Minister of Defence of the UK to become a senior research fellow at University College London at the Institute for Strategy, Resilience and Security to, you could say, think the unthinkable, to review. My background is in legal design, you could say markets. I was a director of a global exchange. And I've been looking at institutions, by which I mean the rules of the game, put it like that, and instruments, by which the analogy would be with the bat or the ball in the game, the instruments by which you play the game. So in the financial world, the rules of the game might be governments, they might be banks, they might be exchanges, there might be international agreements like the WTO, and the instruments are the ones we know and love: debt, equity, derivatives. But there's a new kid on the block: coins. Where does this fit, this new instrument? And what about the blockchain? This is what we think of as Fintech. I was at a party in Norway, New Year's Eve party, and all the people there, or most of them, were actually, talk about the madness of crowds, were buying Ripple and Ethereum and Bitcoin. This is the madness of crowds that we get in what is clearly a bubble. But what is behind this? Where does this Fintech come from? Well, the blockchain is a protocol between machines. It's not between people. And coins are instruments mined by machines. Again, people do not come to this. So we have this virtual digital layer sitting on top of the real world, and clearly the result is not sustainable. But what actually does, why is this important? Well, the blockchain is far more than just a protocol. You've got to look at what it's for. The disruptive innovation, if you like, of Bitcoin and blockchain was authentication. It was the fact that you have solved this problem of what they call the double spend. You can't actually forge the electronic message if it's been encrypted and is unique. So that's one thing, and that is a truly disruptive innovation. Secondly, the blockchain actually is a database, and it's an immutable database. And it's, in technical terms, a shared transaction repository, because it's open to the people who use it. Now, 20 years ago, you see, I've been doing Fintech since before it was even called Fintech, for 15 years or more. And I designed a market transaction repository called OilClear, that was in 1998. And essentially, what we have here, why this is so important of sharing data, and we see this everywhere through banking, everybody is actually looking at, well, what is the effect of this? We're moving from double entry accounting, which is medieval, where I keep my books and you keep your books, and now we've got this shared, it's often been called a triple entry. In my view, this will actually cut the costs of administration throughout commerce globally by at least 90%, probably more. It's truly a revolution, but it isn't going to happen using blockchains. Because blockchains, the fatal flaw in a blockchain is, for every new transaction you do, you encrypt the entire database. That is not sustainable. That is the fundamental fatal flaw of the blockchain. And what about the coin as an instrument? Again, fatally flawed, because it's a proof. It is a proof, in fact, of energy expended, some would say wasted, okay? So if I actually went into a shop and bought a Mars bar, and they gave me a Mars bar receipt, if I tried to exchange that with somebody else for value, they would think I was joking, because a receipt, a proof of past value transfer, has no utility. But a promise of a Mars bar, issued by Mars, actually is worth as much in exchange as a Mars bar is. So what I'm now talking about, or going on to say, is I believe that where we're now moving, the next generation of financial technology, is protocols and promises. And these protocols will not be between machines, they will be between people, okay? Market user agreements, if we can call it that, is the way I see it. And we will be looking at promises. But we do now. What is it banks deal in? Banks deal in promises. Banks actually, I might not know you, I might not trust you, but the bank comes between me and you, and I trust the bank and the bank trusts you. So the bank is, if you like, a risk or trust intermediary. And it puts capital at risk to do this. But there are alternative architectures, complementary architectures to this. A good example of risk sharing, a risk sharing protocol, is in the shipping industry, where there are certain risks that Lloyd's of London, intermediary, will not take. Political risk, for instance. So what happened was the ship owners began to form, I know that Greece have their own, a protection and indemnity club, mutual assurance of risk. And I believe that this is the way, mutual assurance of risk. And what else does the P&I Club have? It has a service provider called Thomas Miller, who do not take the risk, they manage the risk. And I believe that this is the way of the future, that this system I just described of P&I clubs, of mutual guarantee, mutual assurance, it's been around for 140 years. It's a multi-billion-pound business. And there's no reason at all why we cannot see the evolution of banks as risk intermediaries to banking as a service, which is part, I believe, of a fundamental paradigm shift. I was at a conference, the World Energy Congress, 18 months ago, and there was a strong threat there of an evolution away from oil and gas as commodities towards energy as a service, by which we mean heat, mobility, power. These are things that we actually use. So if we can start to imagine credit instruments which are based upon utility, so land use, energy use, we see the petro coin being from Venezuela, which is completely, don't get me started on that, although somebody will probably ask the question. But I believe that the future is about a new breed of financial instrument. It's not a new breed, it's been around for thousands of years, based upon utility. And I see an evolution from banks as intermediaries to banking as a service as part of a general trend throughout the whole of commerce. I don't think there's anything more I can say at this point. Thank you.
Thank you very much, Mr. Cook. So, as I have told me, we had a very diverse subjects covered, and I think it would be fair to say that on the whole we have a very positive message on the outlook both for the euro area and for the Greek economy. But at the same time, the very first message we got was we should not be loud. We should be prepared for the next crisis should that arrive, and we have to balance this issue of the reform fatigue, which clearly we may be in, versus the fact that we're in the best of times in order to continue to reform. Now, within this positive outlook for the euro area, we had some very interesting and maybe opposing, well, complementary, I would say, views on some risks that are posed by the particular nature of monetary policy or stage of monetary policy where we're in, where we have, on the one hand, the possibility that the ECB may be overstretched and may find it difficult in the unwinding. On the other hand, we may have opportunities coming from the labor market, the technology, and the global developments that may make the ECB's hand even easier. Something to discuss. On the issue of banks, again, the message that in this first interventions was given was also positive. So we heard that IFRS 9 is manageable, NPLs are ambitious but totally feasible, and the strategy should work. And in fact, we were given progress on the e-auctions, which is part of that. And also, we were reminded that the resolution of NPLs is a prerequisite for many of the reforms that are necessary to next crisis, which is the completion of the banking union. Technology, the banks, we are told the banks have already been adapting to a large extent, tapping the markets by the sovereign and by the banks. This has been done, and this will continue to be done. But of course, we have some messages that, look, we still are not out of the woods. Regulation will keep on increasing, and banks have to continue controlling the operational costs, reducing the risks, investing. So we've had a very interesting exchange of ideas on that. Now, we have about 35